Okay, welcome everyone. We'll start our lesson one. Today lesson, as a couple of you know me, my name is Anjum Sattar and my email address anjum at ukuniversity.co.uk. If you have any question, you can drop me email as well. I'll just type in the chat box as well. Okay, so we'll start. Please make sure you have a Moodle access. If you don't have it, please let us know. So what we can do, we can try our best and our admin will look and set up your account. If not, so all the resources will be available on our Moodle. Other than that, I can send you some resources. Normally, I carry on sending the resources which we use for F9, ACCA, qualification as well. The mixture of resources is good to be. I can normally carry on referring which question or which learning outcome where we can find. Other than that, we can use the Kaplan, Osborne, BPP, these resources we normally embed, in our lesson. So today lesson before starting, let's look, the unit specification. Always good to be explore what we're supposed to do next few weeks. Okay, so of course we're looking the financial and management control. So management is a process of designing an environment to achieve the objectives. So control is very crucial. So plan and control. Control is a corrective action. So we need to be look around. So our learning outcome one, understand how to improve the business performance. So when we look the performance, don't look just the financial performance. Always nowadays we look non-financial performance less in such as CSR, corporate social responsibility. We look around the sustainability, focus on three P's, profit, planet, and people. Uh, Always, social accounting keep always in mind as well when you're looking at the performance in the real world. So evaluate the actual business performance against the business target goals, and we can look around the variance why we have, what are the reasons behind. Evaluate the cost reduction method, which we can look around engineering values, different life cycle costing. These methods we can, and we can look around the purpose of appropriate business performance improvement. So when we're looking at the business performance, it's better to keep in mind the balanced scorecard model, or we call BSC model. So which is published by Norton Kaplan, balanced scorecard model. That's quite good to look around and think about, why we don't have a Nokia anymore. Yes, because Nokia was the world leader. They just focus on financial objectives because they close many research and development centers throughout the world. They save the cost, but ultimately they not innovate. Another company they capture the market. Then so we need to be think about whatever we do, what impact will be in the long run. So assess a continuous quality improvement, which we can look around continuous improvement because like TQM, total quality management and continuous improvement carry on reflecting. That will be our lesson one. Lesson two, each lesson will go through one learning outcome, which will address, our lesson normally designed according to assessment criteria 1.1, 1.2, 1.3. M is a merit criteria, always good to be work towards distance or merit and be able to prepare the budget. So second lesson will go through budget, budgetary control, variance, which a couple of you already learned in the management accounting and decision making in ATHE or financial performance used to call and understand internal and external factors that affect the organization which we can look around internal and external factors, how they affect, we can look at external environment and we look at the various source of information, cost reporting and financial performance and different measures. So that will be all. Each lesson we have indicative contents which we look, in our lesson. Overall, our discussion will meet the learning outcome. Variance analysis, variances mean difference between budgeting and actual. Of course, variance can be favorable or adverse. Always look around the causes of the variance. Why? Is it due to the estimate, the lack of information, or the things wasn't in our control, the environment, we carry on adjusting our things accordingly. Okay, target setting, target need to be realistic. When we set target ideal or attainable and different standards we can and target we can set accordingly. So we can look around the value engineering and value analysis. and balance scorecard, as I mentioned, and the cost driver who drive the cost, the various cost drivers can be like, absorption costing and ABC costing. And ABC costing, we look at cost drivers. And each lesson will go through the indicated content as according to the learning outcome. Okay, so today lesson will look at LO1, learning outcome one. Okay, let's start. Please, during lesson, if you have any question, feel free, you can ask and go through. You can interrupt me. Okay, so understand how to improve the business performance. So business, when we say business is any legal activity, whatever we do, is and every business have an objective to achieve. So we can look around the mission, we can look around values, we can look around the corporate objective. Evaluate the business performance again, the business target, evaluate the cost reduction method using the value engineering, and propose appropriate business performance improvement. So that's we can look around, evaluate the actual business performance again, the business target. So budgeting. Budget is the estimate and the prediction of your business income for the set period of time, and estimate of your business expense for. So normally the budget are the target you set, always look the sale forecast first, because any budget you make is linked with the sale forecast. If we expecting the economics growth, we expecting the sale forecast, where we can get the information. So always good to be go on the ONS website. ONS is the Office of National Statistics, where we can look around the information. Okay, so Office of National Statistics, and look around the inflation information, GDP, employment. Yes, so look the most latest one. So that we have, So other, of course, monetary and fiscal policy of the government is quite good to explore and carry on looking. So that also help. Okay, so budget involve the define the financial objective, assessing the finances and using the information for planning. So budget help to balance budget is a set nav is provide, so if we don't have a budget, so we can't really measure the performance accordingly. Okay, however, to get the most out of the budgeting, you need to be identify and analyze the budget variance. So what is the variance? In the risk management, what is the risk? Risk is mean probability of happening something. In business world, we call the risk is the beta factor. Higher the beta, higher the risk, higher the return. So we can look around every company wherever we invest, like if you go on the Yahoo Finance or any other website, where we can, so any company of your choice. So you can look around the beta, and like here we can look around Amazon, we can look around eBay, and then you can decide, which one and what risk. So here we'll see the beta factor, which is, hope you can see it. Okay, so we have a beta here is 1.16, but if we look the EPS, earning per share, is 2.90. So earning per share. So if we look the eBay, and we can find eBay beta. So if we look the eBay beta is 1.131 instead of 1.16. So the eBay is a higher beta, but we look the EPS. EPS is 5.21 instead of 2.9. So EPS is a higher than the risk factor. So risk is only instead of 1.16, so it's 1.31. So it's a 0.15 is higher. So that's also help us. So always good to be, don't put all eggs in one basket. We heard the quotation. So it's good to be, we can look around, diversify our investment in different projects. So it is calculate finding average of squared standard deviation from the mean. In general financial management, a variance is the difference between the actual and budgeted income. So higher income in our favor, and we can say the variance is favorable, but higher expenses compared to the budgeted is unfavorable. So if the result are the better than the expected, the variance is the favorable, otherwise it's adverse. So type of variance, always material cost variance have two sub variances. which is material usage variance and material price variance. Sometimes we think, come on, we'll buy the material from the cheaper supplier, various company with respect, maybe Chinese company are because different quality standard in each country. So we can look around and the cost wise maybe it's cheaper, but when we look the quality and the European standard of quality, so that can be a variance of the usage, but the price variance can be favorable, the usage variance can be adverse. And in the long run, maybe we can look a link to the customer return the goods, yes, and the customer satisfaction level we can look around about against the product. Okay, labor variance. Labor can be two types of the variance: labor cost, labor efficiency variance, and the labor rate variance. So if you're paying higher rate to the labor, you're expecting the higher efficiency from the labor as well. And ultimately, the ideal time can be low, and we need to be look around what is impact on that, in terms of the material usage. If the skilled labor, the material usage also linked with the labor efficiency and the labor rate. Okay, so variable overhead variance, which we can overhead indirect normally cost, which we can look around variable factory overhead variance, which we can fix overhead, and we can look around various other types of the variance as the variance are. Okay, so when we look the variance price, as we mentioned, the usage rate. So any variance, please always think about the flex. If you know the standard of 1 unit, so if you're making 100 units, so you flex it what the standard cost for 100 and what the actual cost you. So always think about the flex first. So that's always help you to think about the variance. We can give you that if you want to learn more about variance. I can give you separate handouts which we can look around and explore about various variants. Okay, so these are all different types of variants which we can look some of them. So calculate the variance, explain the meaning of the variance, identify the possible causes of the variance. So variance, which we can look around the calculate operating statement, where we can reconcile and we can look around what impact I have due to the variance. And absorption costing or marginal costing. Absorption costing means is also known as the full cost, and marginal cost means the cost, all the variable costs or additional costs. Under the marginal costing, we also look around the short-term decision making, such as a break-even analysis. So break even where no profit, no loss, where we meet the total cost. So budgeted variance, we can look around the current variance, we can look around drivers, we can look around the causes, we can look around the impact and expected outcome and projected. So that can be look around. So yes, what you measure. So by low quality with the material and the price, which we just mentioned, we can look around what impact will. So strategic target setting. When you look the target in the long run and the action plan and budget and the variance always need to be think about. Understand the baseline and the vision and the determine of the most effective set of the performance improvement. See with the process which require the measurement, validation, and frequent measurement of the goals. So we can, yes, please, we have the video which we can explore in our time, which we look around when we say targets need to be realistic. Yes, target settings, strategic is mean long term. Always we have a data, information, and knowledge. Then we can set the target, which need to be realistic target. Okay, so when we look target setting process, so always good to be you look the objective success map, how we can look around the objective, prioritize them, operational, we can look around different operational efficiencies, data collection, data analysis, set the target and action plan, and we can discuss, and then we can agreement with all the stakeholders and their expectation. We always need to be keep in mind as well. Okay, let's move to the look in 1.1, and we'll go to 1. Evaluate the cost reduction method using value engineering and life cycle costing. Any question until now, please, if you have, Mark?
No, that's fine. Thank you.
So value engineering is the technique in which the firm products are subjected to the critical and systematically examination by a small group of specialists. They can representing the various functions such as design, production, sales, and finance, and the planned scientific approach to the cost reduction, which we reviews the material composition of the product. So we need to look around the modifications can be made. Don't reduce the value of the product to the customer. So we have to increase the value. So we have the concept VFM, value for money concept. Yes, value engineering or value analysis. Question to ask, does the use of the product contribute value? Is the cost proportionate to the usefulness? Does it need to be all its features? Is anything better to be intent to use? Can usable part to be made at the better at the lower cost, and can be standard product be found which will be equally usable, and we can look around the appropriate tooling and considering quantities used. We can look around the material, the labor, and overhead constitute the total cost. We can look around the another dependable suppliers provide for the less cost. What will be the quality as well? Is any buying it for less than the stated? And we can think about EQM, economics order quantity, when we order things, as well. That's also keeping in view of. Okay. So why carried out the value analysis? The most powerful analysis method financial managers can use to analyze the company's cost structure. Yes, here when we look the cost structure, we can think about the fixed cost, flex cost, opportunity cost. Yes. So we need to be think about all waste elimination, and we can reduce the waste, because if we have a storage cost high and it would stay in our warehouse longer, is also cost as well. And we have opportunity cost, which we are missing opportunity. We all need to be look around the improvement in the product design, cost saving, new idea generation. Okay, activities. We have one of the author is called Porter Value Chain Model. It's quite good to be explore about Michael Porter, one of the great scholar. He published books. He gave many models: Porter generic strategies, Porter diamond model, Porter five forces. Here we're looking the Porter value chain. We can Porter saying, we have some primary activities like inbound logistic operations, outbound marketing, and service. That are the primary activities that need to be linked to the sportive activities, and the primary and the sportive activities. We need to be think about how they work together to create the value, and ultimately the primary and the secondary activities. We need to be as a single unit, and it will create the value. So is a systematic and objective valuation, the value of the goods and the services, and the function is an input relatively. So we need to be, when we make the decision anything, so we need to be involved other departments to, and ultimately, they should be aware of, and it will create overall value or the competitive advantage for our organization. Okay, so benefit of value engineering when we do the value engineering. So customer capital expenditure, what is meant by, so capital and revenue already you learn about. Anything you spend buying assets and things or improve the value of the asset is the capital expenditure. Operation and maintenance and project deliveries, we can look around headcount, project schedule, operational impact, health and safety, of product training, leadership commitment, and multidisciplinary teams, team management. Ultimately, this also increase the value. If we have the people are at the recruitment and selection process, also help, to bring more value, increase throughout, optimize, the product mix, and early warning, poor performance. We have a system in place, so systematic approach to maximize the value and minimize the cost of the project. That's really we need to look around, and we need to reduce the risk of the probability. We can think about how we can maybe transfer the risk, or we have a strategy mitigating risk, those the risk will just need to be maintained. Okay, so value engineering across the organization, which we can look around, apply the capital project, prioritize the project, define agreed value. We can think about deal with the key enabler reviews, which we can predict process issues and those, where the gaps we have, the best practices we need to, and develop the guidance and template methods, and define, governance and the role and training capabilities, ability to do something. We carry on renovate them, because if we carry on doing CPDs, actually we are carry on improving and Okay, so the next we have, if you have a question, you can ask, please. And the life cycle costing is the costing which we can hold the product life, the life, of which we can asset is not just the cost of the asset in the project. Okay, so useful when the project alternative that fulfill the same performance requirement but differ the respect of the initial cost and operating cost and compare the maximized net saving. So some other common use of the measure net saving, net benefits, so we can do the cost benefit analysis, cost benefit ratios, internal rate of return, payback period, net present value. These are investment appraisal methods can be used. And life cycle costing is ideally estimate, overall the cost of the project alternatives, each, which we can, like if we hire the machine, we can lease it or we can purchase it. So what are the benefit of? So if we have, our own cash, we save it, what opportunities, what risks, the car, if we not investing it in the project. So initial cost, the service cost, that is, yes, we can even look at the end, what will be the resale value, our disposable value, and the life cycle costing, operating cost, and disposable cost. All we need to keep in mind. Okay, so lower overall ownership cost without the difference in the functionalities, which we can look around the quality and need to be performed during the initial stage and design. And they also we can link around other the tax, like if we buy own car or you use others in the costing perspective. So effect are then quantified and expressed in the monetary term. So life cycle costing, we can look around. This is one of example of the project which we can like how much we have a cost. So research and development year one, design, production, marketing, distribution, and all. We have these at the cost. So we can look around the life cycle costing in these research and development, production, marketing, which we just mentioned, and we add them in the what will be the total life cycle cost. So which we can look at and we can calculate. And 1.3 propose appropriate business performance improvement. So which we can propose and we can look around so we can look around in the broad level, in overall strategic level, we can look around departmental level, functional areas like marketing and finance, all, and team level and individual levels. So always need to be think about what will be and we need to be work towards. So performance can be measured impact. So normally we carry on looking 360-degree appraisal as well, appraisal method. So that also help to measure the performance, quality, retention. So balance scorecard, financial perspective to reduce the financially what kind of financial performance should be our to our stakeholders, internal business perspective to satisfy stakeholders, which we can look around, ID various stakeholders and their innovation and learning, what we are learning, are we in and how we'll sustain our ability improve innovation and customer perspective, are we in how should we see in our customer? So like we put ourselves in customer shoes, we see according to the customer eyes and we want to increase the value. So we shareholders, greater shareholder value is old. Of course, we can look around the concept, but we are moving towards from shareholder just value to the stakeholders value maximization. We can look around, make the strategic decision, make the either maybe acquisition. We can carry it out assessments and return on the cash to the shareholders. We can look around the reward operating units. We can look around the reward in the middle managers, not just only. So we have a remuneration committee or the corporate governance, how we can well go on. Okay, it is claimed by 70% of the performance measurement initiative fails. Measurement of the wrong things that are easy to measure, excessive measurement data overload, and maybe that can dissatisfy demotivation and the cost is higher than the benefit. So data access issues, sensitivity of the fields of the measurement, data analysis, interpretation maybe can be static or out of the date measurement methods can be, which we need to be make sure. We can look around the sport, strategic objective. We can look around appropriate, the balance, financial and non-financial, not just only focus on the financial objective, guard against the sub-optimization, protected by Skinner and various other authors they mentioned. We can look around the number of performance, which we look in a minute, and be accurate and be clear purpose, not clearly and smart and achievable, yes, in the time frame. And when we look the balance scorecard is quite good to, we can say balance scorecard, and you go by Kaplan. Kaplan is a publisher. We can find the chapter of the book or the Kaplan resource bank, which if we'll click there, it's all performance. Okay. So here we can look around the balance scorecard as we discussed. So what will be the customer perspective? So lower cost. So we can look around the benchmark cost versus the competitor cost. We can look around the high quality, zero defect, responsive service on time, delivery. That the customer perspective can be measured KPI. Internal perspective, operational excellency, which we can look around production cycle time, rectification time, production complete on time, within the budget, that we can look around internal perspective. We can look around innovation perspective, innovation, the percentage of income from the new product, or internal learning implies suggestions, percentage of implement, percentage of the time spent on that. And financial perspective, we can look around ROE, the return on capital employed. We can look around the survival cash flows. We can look around the growth and quarterly sale growth, which we can. And these, and we can make the strategies accordingly. We deal with the people and all, so it's good link which we can explore, and a lot of examples there. So that help us further in the real world how we can do it. Okay, so that was the balance scorecard model, which is good to be how we can map the step, yes, identify objective, define, organization, how we can create value. So these are the good steps to look around. Okay, so today lesson really we look around variance, what is meant by, and we discuss, but we'll calculate the variance in the following lesson. Okay, so variance is the difference between budgeted and actual performance. We discussed value chain model Porter. That Porter value chain is good to further if you want value chain Kaplan, and we can find a lot of examples there. And then we discuss about the FC balance scorecard, and we discuss about budget, and we discuss about costing, and we discuss about cost and benefit analysis, and we discuss value engineering and VFM, value for money, and we discuss about risk. And we said risk is mean beta, high the risk, high the return, but we need to be think about how much risk we can take it and measure it, and that's that's the way. Otherwise, we can use the approach is SARA, and SARA approach we can transfer the risk, we can avoid the risk, we can respond to risk, or we can accept the risk, how much we are able to accept it as a company, and that can be looked around in the light of these approaches. Okay, that's all from my end. Any questions, please?
No, not for me, thank you.
Thank you. So this week we look this, if you want to be look around and you want really enhance, in terms of, so we have one of good website which normally we use to be, make sure I'll stop it. I think. Okay, so that's quite good to look around